Let's welcome in Pankaj Sharma. He's Head of Equities at Equirus. Thank you so much for joining us, Mr. Sharma. Pleasure having you on our show. And I'm going to dive in straight into the stock ideas you've given us because, you know, it's rare to have a person who can give us on the show and give us detailed ideas. I'll start with, I know your first call was Ashoka Buildcon, but I'm actually going to start with JSW Energy, which you have said is a buy for you. Have yesterday's numbers changed that at all, or you continue to have your belief?
No, not really. I think that on a quarter-to-quarter basis, you could have variations in a space like infrastructure, because you would appreciate that many of these power companies would have capacities which might be having temporary issues, and they keep changing on a quarter-to-quarter basis. But fundamentally speaking, when I look at this stock, there are some very good things which are happening with them. One is they're in such a shape today, and balance sheet is good, that they can look at the acquisition opportunities at a time when the sector is not really doing that well. And there is a lot of distress in many of the assets which they are acquiring. So this is a great opportunity for someone like JSW Energy, and I think they are capitalizing on it very, very well. Also, I think in terms of their core business which they had, the organic growth which they did in last 5, 7, 10 years, and the capacity which they have tried to move from a very risky model which was exposed on both the sides, on the fuel cost as well as PPAs. They have tried to manage that situation very, very well, and I think they have been reasonably successful in that. So they are getting into more contracts when they have to sell power, and also trying to cover the fuel contracts as well. So I think combined these two factors, I would believe that it's an opportunity for investors to look at something like JSW Energy, which is very much well placed in the space, and compared to many other names in the sector, I think that the management has really played the game very, very well in last 2.5 years. So I am continuing with a positive view on this, and would believe that this one stock which would give you at least 40 to 50% return in 2.5 years time frame.
40 to 40%, 50%. But I'm going to continue to just focus on the risks, because so that you can convince us and our viewers. Let me look at JSW Energy. Mostly its PPAs are in the south, and right now 2 PPAs, at least the Karnataka PPA, has to be renewed, and there is a delay, because of which we've seen a downtime on JSW Energy's plants. The plant load factor has been slightly lower. The rates in Tamil Nadu has actually dropped. If you look at it, the tariff rates that the SEBs are willing to pay has dropped. If I look at JSW Energy's own commentary on merchant power, they're being a little bit more circumspect about the possibility of growth of merchant power, right? 3 issues when it comes to tariff and its revenues, which is essentially related to power purchase agreements with southern states. The second point that I would take up from is what you said about the fact that JSW Energy has a very strong balance sheet. It can go and buy these stressed assets which are sitting there, which banks would be very happy to force managements into, nudge managements into selling, because to restructure loans. But the problem is those assets actually have no takers. I mean, I have the money, and if I go and buy an asset, there is no PPA for it. There is no line of coal from Coal India. Now, why would I think that a company which goes and buys those assets has something to invest in? I'm just being the devil's advocate so that you can convince us and our viewers.
No, I think these two are very, very fair points, and very genuine questions, and we keep getting these questions from the investors as well. I would tackle the second part first. When we see a situation where India has added a lot of capacity in last 7-8 years, and commensurately the demand has not grown that much. So we are in a situation where we have some kind of a balance between demand and supply available. In this kind of situation, there is really no urgency for any state government to really sign new PPAs, to really look at new capacities which they can buy power from. But it's not going to remain like this. What we have seen in the case of, let's say, someone like BHEL and many other companies which are equipment providers, things have not been great for last 2 to 3 years for them. And what it means that in a 2 to 3 year situation, we would have a time when the demand would continue to grow. We hope that 7.5–8% kind of a number if we deliver them on GDP growth rate. And at the same side, you would not see that kind of capacity increases. So you would definitely have a slight shift and preference for assets which are currently available and which can be used to generate power. And then state governments would be more willing to sign PPAs. And so far what the game they have been playing is that they know that there is a lot of capacity available and they just want to delay the purchase. And also one very important factor that has played a role in this is that merchant tariffs and open capacities are operating at very, very low tariffs. So if you are a buyer, it really doesn't make sense for you to sign a long-term PPA at a much higher rate. You can buy it today in short-term contracts and in merchant power market. So I think that it's not going to remain like this. Power sector and assets, typically they are for 25–30 years and even more. And in last 2 to 3 years and next 2 to 3 years, you have a stress in the system because demand has not grown as supply has grown. But this is not going to remain like this. We believe that someone who is building up capacities which are good, and believe me that if you look at the acquisitions which they have made, they have done, I think, a lot of due diligence on the kind of assets they are buying. So they are really not looking at assets which are not great. So for example, the acquisition which they are trying to do on Jindal Steel and Power, a 1000 megawatt plant in Tamnar, that is something which is a fantastic asset. It's an asset which has very, very low operating cost, brilliant BHEL machines of 250 megawatt each. And this is something which makes it a great plant, and JSW Energy has done well to acquire these kind of assets which are really, really very, very good. And on the second part, when we see that all these issues related with PPA signing and the decline in tariffs, I think this happens because when you see, let's say in last 3 to 4 months and maybe even 6 months, the power demand has been growing reasonably well. In South, there was of course a bit of impact because once the elections got over in Tamil Nadu, there was an impact in terms of how much power the state would buy. Also, this happened in Kerala. So this is really a temporary situation, and whenever the government changes, you would see that it will take a bit of time in many of these southern states to complete the formalities and sign these PPAs. But having said this, it's not really going to be a permanent situation. And on a quarter-to-quarter basis, as I said in the beginning, that it's not going to be a number which is more like maybe a FMCG number or maybe even IT. What would these companies report? Infrastructure companies would have lot more variation versus many of these companies, which would have a secular kind of growth trend. In fact, power companies especially would see huge variations between
good buying opportunity. JSW Energy is down about 1% today, so perhaps a good buying opportunity if you're following what Pankaj Sharma is taking or talking about. All right, let me go to your second big choice, and I can see that you're essentially perhaps looking at companies which have strong balance sheets in stressed kind of sectors. So road building, where a lot of people have bad balance sheets, have a big debt on their books, have poor interest coverage. You've chosen Ashoka Buildcon. Strong balance sheet. Again, just give us the idea of why you've chosen Ashoka Buildcon.
Yeah, you nailed it right. I think we are looking at these sectors where there is a lot of stress, and we prefer companies which are relatively better placed to face this stress. And in Ashoka Buildcon's case, the balance sheet is pretty good. Also, in recent past, in last 2 to 3 months, we have seen that issues came up for them on the regulatory side, and there were some issues related with compliance. But I think once the fundamentals start to play out a bigger role, which has been the case in road sector especially, this is one sector which has done very, very well, and I hope that this will be the case on the back of good traffic growth and good momentum from government side as well. Ashoka Buildcon is extremely well placed to benefit from these opportunities and capitalize upon them. So I believe that once you are in a sector that is seeing revival and your balance sheet is good and you are fundamentally not in a distress, you will do very, very well in a 2 to 3 years time frame.
Right, and I'll be honest, it's very difficult to find the risks in Ashoka Buildcon, but I'm still going to try it just to be the devil's advocate again. One looks at it, 9% last year, 9% volume growth in traffic. It's very rare to have a BOT doing so well, especially BOT projects have got so badly beaten down. EPC business coming very, very cheap at the moment, and if one does that valuation, pretty strong company, there's no doubt. But two risks that I can identify, of course, is when you do BOT, everything is on you, right? It's not like an EPC contract where the government says, okay, here is a project, we have acquired the land, you just have to build it. BOT means you acquire the land, you operate it, and then you transfer it after a certain longer time. There is a higher degree of risk involved there, especially when you are moving from one state to another. And if I look at the strategy that Ashoka Buildcon has generally taken, is to build roads from productive states, right? It tries to focus on areas where you see that movement of good amount of freight, so that you get good commercial toll from that. But that is a risk that you have to do everything yourself.
Yeah, it is. It is a risk. I agree. There is no doubt on that. And I think this is something which has impacted the sector also in last 5-7 years, because when you have so many uncertainties and so many variables involved, it's very likely that you would falter on one or two of them, and then things will go for a toss. But this is something which the government has also tried to correct in most of the situation. Also, I think you have to find a balance, because when I see that not everything is bad and not everything is good, but if a company is prudent enough to look at the opportunities and find a right business mix between, let's say, an EPC and BOT, and between BOT also the kind of states you are operating in, what kind of understanding you have developed in local market, of course there is an opportunity there, because if everybody is worried about risk, then probably you would also get a premium for that, and that is something which you have to be very, very careful about. And I think Ashoka Buildcon has done that very, very well. So yes, BOT inherently would be a more riskier business versus EPC, but again, there is a risk premium which you get, and if you do it well and manage it well, I think you can make a lot more money compared to what you would probably make in EPC business.
Right. In fact, if one looks at 78,000 crores worth of road building projects are NHAI has announced for this fiscal, out of which EPC is one part, but BOT I understand is almost 2/3 of it is BOT, right? And Ashoka Buildcon, I think the management has guided between 4,000 5,000 crores that they expect in terms of orders from here. How are you valuing it? What is your target on Ashoka Buildcon?
See, I think there are two things. One is that, as you rightly pointed out, that government is doing a lot of good things in this space, and the ministry has been very, very dynamic in sorting out the issues. What we do is that we have a price target of 218 rupees on this, which means about a 30% kind of upside. And we value this company by looking at the price to book multiple for the BOT business, and also looking at the EPC business contribution. So it's more like a combination of both, where we are valuing the BOT business separately and we are valuing the EPC business separately.
Right. Pankaj, just wanted to ask about Torrent Pharma as well. You know, this is one name that has done well. They have very ambitious capex plan, but it's not cheaply valued as well. How would you look at it? Or your earnings estimates are way higher than consensus?
Yeah, hi Pankaj, good morning. So I think this is something which is very interesting about Torrent Pharma. If you look at the entire pharma space, I think this is one company which in my view, would have much less appreciation for the kind of pipeline they have built for the new products and the business. Perhaps it's because they don't talk about it much, and also because they are not very good in highlighting it. But when you see that the kind of pipeline they have, the kind of R&D they have built, and the 3 years horizon, I believe that it's a company which would definitely surprise the market on the positive. And though I agree that you don't have that kind of valuation which would be called attractive, but it's also based on the kind of earnings you are looking at. So let's say if you think that there is an underappreciation for the company's work and the pipeline, and earnings could be much better than what currently the street would be factoring in, the valuation would not really look that expensive. So my view is that it's a pipeline which is much less appreciated than how it should be ideally, and that makes me believe that earnings could be good and better, and that makes me believe that the valuation is not really stretched at this point, and this company we should do well.
Right. So, if we just look at, Torrent or, any other pharma company, the main game-changing event has been that when they launch drugs, new drugs coming into market, they may be generic, but, there is low competition over there. Is that the pipeline that they have? Have you studied their pipeline?
Yeah, of course. I think in the pharma space, our pharma analyst Nimish is a very strong guy in understanding the pipeline, and I would probably call him that he is much less a valuation analyst and much more a pharma pipeline analyst and the sector core understanding analyst. And we have understood it well. We have studied it, and we believe that that is going to be the case for Torrent Pharma. And that's what I meant when I was saying that the pipeline for Torrent Pharma looks extremely good, and this is something which is based on very careful analysis of the pipeline for next 3 years, and it's based on all the filings, it's based on all the regulatory reports which come out, and this is not really based on a hunch or kind of hope which we would have from Torrent Pharma. It's based on solid data.
Right. As far as some of your other calls are concerned, Gujarat Mineral Development, you expect a 23% upside there. I think it's a name which is slightly on the lower side. No, it's up about 1% or so. How would you look at GMDC?
Yeah, I think this is, Pankaj, very interesting, because I think it's one of those names where it has been flying below the radar. I would say that, of course, the volume growth has not been great, and there have been issues with the company. But I think this is going to change in next 12 to 18 months. I believe that the volume growth would be a very positive surprise, and also we are going to see much better cash flows from the other businesses which they have. So I think once that happens, people will probably start to giving it much more benefit of doubt, in the sense that things may have been bad in last couple of years, or maybe not in line at least versus the expectation. But I think this is going to change in a more meaningful way in next 12 to 18 months, both in terms of the volume pickup and also the contribution from other businesses and the kind of cash flow they would see. And also I think what we are seeing, it's at a level where there is absolutely very low risk of any kind of downside, because a kind of worst case scenario has been built in the stock price, and that is going to be a very strong support from these levels for this stock. And I believe that even if there is a small positive change for the company, probably investor would start to get a bit more interested in the name.
Right. You've been tracking infra for really a long time. And we've seen a lot of rally into names like BHEL, L&T, some of the other companies, which we've been tracking. Do you think BHEL will be able to meet the street estimates after the recent run-up?
Very, very unlikely. And I would think that in BHEL's case, nothing much has changed fundamentally, and I would not really think that there is a kind of probability which is there in next at least 6-12 months to get numbers which would be much better than estimates. And also because of the fact that I think more than the actual delivery and actual quarterly numbers, I think what Street would be interested in is to look at the product pipeline and the order inflow pipeline. And I believe that FY16 has been a great year for them. After a long time, they did about 35,000 to 40,000 crores kind of orders, which was very, very good. But to sustain this level in FY17 and FY18 would not really be easy. So this is something which is not really linked to fundamentals in my view. I think BHEL was a beaten down stock. BHEL was struggling for a long time, and then when people found that there is an opportunity to buy something which is a decent company otherwise in terms of corporate governance, in terms of size, etc., people thought that let's take a chance. But fundamentally, I really don't think that anything significantly has changed for BHEL as such. L&T's case is slightly different in the case situation because it's the only name which probably you can play if you want to play India, and how the markets have done in last 2.5, 3 months, or maybe 4.5 months, I would say, after the budget on 29th Feb. I think is largely in line with that view. And also the numbers were very, very good. So if I say that whatever outperformance and whatever good performance L&T has shown is linked to two factors. One is that in general, more interest in India, and L&T is a good way to play India. And secondly, the numbers were also very good in 4Q.